Welcome guys to my video. Happy New Year everyone. I hope you had a fantastic Christmas and I hope you had a fantastic start to your new year. So guys, I'm going to be discussing my balanced portfolio or my viewpoint in terms of how I'm going to approach setting up a balanced portfolio. So I do have investments in place and I have put them into different chunks, different industries, different commodities, the property side, but I thought it would be useful actually to discuss a balanced portfolio and how I'm going to be approaching it. And I thought this would be useful for those guys that are maybe getting into investments, already in investments, but their portfolio, or let's just say their investments, is very how do you say, it's not balanced. So they might just have stocks here, they might just have it in their own country. So I just want to address that so I can give you guys some ideas and I can share my viewpoint on what I regard to be something that's well balanced on the investment side of things. And guys, do feel free to share your viewpoint on this. It may be that there's loads of people out there that have a better understanding and a better, how do you say, idea around of what would account for a balanced portfolio, and any recommendations I will highly be interested in. So guys, what I'm going to do, you're going to see my notes on my iPad coming up because I have like a small kind of single-sided brain where I don't remember everything. So this, the notes I've set out on my iPad, you're going to be seeing it very shortly, and I'm not going to be reading it word to word. Essentially, I'm just going to be explaining it, so it just triggers the points in my brain as well. So if I do keep looking down, it's just, I'm just looking at my iPad and my notes, but you're going to be seeing those coming up now, hopefully very shortly. So let's get into it. So firstly, what I want to say is when it comes to attending to or creating a balanced portfolio, investment portfolio, everyone's desired risk, everyone's desired outcome is going to be different. So according to that, the way you create the portfolio is going to be different for everyone. There's some people that if you're, let's say in your 20s, you're willing to take a bit more risk or higher risks, you can attack that by putting all your money into stocks and a little bit less into funds. And you have also your cryptocurrency. You know, younger people are more willing to put their money into there because even if you lose your money, it's a case that you're still young and essentially you can just keep building up at a later point. For those maybe in their, like say, late 30s to 40s, it may be a more safer approach because you're saving up for something in Pacific or your retirement. So in that case, you don't want to be heavily putting your, say when you're coming to create your portfolio, putting it into something that's very high risk. So do bear that in mind, guys. That is going to be an important factor. So let me discuss my ideology behind it, how I'm going to attack my balanced portfolio. So my idea behind this is to be creating something for the long term. So having a long chunk of money, sorry, not long chunk, a huge chunk of money and making lots of profits from my investments. So essentially with that in mind, it's not, I wouldn't say it's aimed at retirement. I'm just, you know, I just want it for just a huge chunk of money sitting there with a good amount of profits. There's no highlighted or specific purpose. I mean, at a later point, you know, that might become more important for my retirement. So I might change the investment portfolio a little bit to make it a little bit more safer, because some of the things I'm going to be going through, there is a percentage of stocks, individual stocks I am going to be putting in, and I think at a later point I might change this kind of portfolio around. So yeah, like I said, I don't have a desired purpose. It's just the case that, you know, I'm going to save the money so I could just have it in the future. I don't really know what, I don't have a, you know, I'm not saving for anything in Pacific. I am saving for my retirement, but that's coming from my, you know, the money I'm saving with my employer. So that's something on the side. This portfolio isn't aimed at my retirement. So that's all I pretty much want to say there. In terms of my risk levels, I'm going to say I'm going to put my risk levels around medium to high. So I'm not going to be going anything too low. Medium to high would suit me perfectly. I'm at this point where I don't mind taking a little bit of higher risk, but again, not too much of it. But again, guys, you know, you need to assess this and see financially whether you're willing to take higher risk, because investments, they are risky. And just, I should have mentioned this at the forefront, I am no financial advisor. This is just basically my Viewpoint investments and how I'm going to attack my own portfolio. If you do need any kind of advice, you need to seek it from a financial advisor, or, you know, someone that has more knowledge in it and is certified to provide that knowledge. I'm not certified or, you know, educated in that way, formally, that is. So firstly, I'm going to be taking out stocks. I'm not going to go for like a heavy percentage in this. And essentially the primary reason behind this is that stocks, individual stocks specifically, I just class them as more higher risk, because you're just putting it into one company. And, you know, this one company can anytime like have some kind of major financial issue, and you could essentially lose your money. Your money is connected to that company. So I just regard this as a much higher risk. So I would say that I would be putting around, say, 20% into stocks, and I'll be discussing at a later point in terms of the stocks I will be choosing. Also, I'm going to be putting money into bonds. I haven't actually decided the type of bonds I'll be putting it into. I need to think through this, review everything, you know, which, you know, whether it be government bonds, corporate bonds. I need to have a look into this and decide, but I'm just going to be putting a minimal amount into there, like 10%. I don't know why it doesn't catch my attention too much, but guys, for those that do know more about bonds, what's your thought on it? I think from my understanding that some of them are not that high risk, so do let me know your thoughts on it. 60%, I would say 50-60% of my money is going to be put into funds. So funds is essentially, like, say for example the S&P 500, your risk is more proportioned amongst lots of companies. So it has, the S&P 500 has the biggest companies in America. Your risk is proportioned amongst all of those. So you're taking a little chunk into all of those when you're buying one share. So ideally, that's more suited for me. That's why I'm taking a bigger chunk in this. It is still risky. Do bear that in mind. Just because you're putting it into a little bit of just because you're putting it into more companies and a little bit in each, it doesn't mean the risk is less. The risk is still there. It's just that it's not going to be as risky as if you put it into one stock, because you have so many, you have a diversity of companies then. Some of them are the big hitters like Apple, for example. You have Google. I can't remember, I think they're Alphabet on there. And yeah, you have some major companies in there, and it just proportions your risk out nicely. And I think funds are very, very attractive. So for those guys that are beginners to investments, guys, I highly recommend start off with funds. I recommend it. Again, seek financial advice. It's a good recommendation in the respect that your money is proportioned into so many companies that it just makes it easier for you. You don't need to go out there and choose a specific company like with the stocks. You don't need to choose, like, say, Tesla or something like this, especially if you're new and you have no clue about investments. It could be that, like, for example, my cousin put in, I think, around 3,000 euros into Tesla, and quite quickly it dropped to 1,500, which is like, that's how risky it is. And that isn't to say the risk isn't the same with funds. Of course there's that risk, but it's going to be slightly more less just due to the diversity and the quality of the companies in that specific fund. But all funds are different, so bear that in mind. And also, when it comes down to it, I'm also going to keep a little bit of cash. The reason for that is, but I'm not going to keep it in my investment account. I'm just going to keep it on the side. So I'm actually using, if you haven't checked out the video, the Plum Money Management app, I'm going to use that as a tool to keep some spare cash on the side, just in case if there's any emergencies, you do need some spare cash. But you can keep it in your investment account, of course, just in case investment, that a specific stock, maybe you keep an eye on, it drops in value, you can take the money out when you need it. If you have it sitting in that cash account to use to buy that investment. But obviously I wouldn't recommend that. I'll say keep some cash on the side. If there are any issues and emergencies, you can take it out then and there. And I would say that's really important, guys. Do not put your emergency funds into investments. You could lose that money if there's an emergency tomorrow, your car breaks down, someone's ill, and you have some kind of expense. You can't put your emergency funds straight into investments. I mean, yes, you could be able to take it out, but you don't know what will happen to the market tomorrow. So please bear that in mind. That's a very, very important point. And just to also, when it comes to diversifying your portfolio, guys, you'll see like a pie chart hopefully coming up. Like I said, it's going to be funds taking the heavy majority of my money, then stocks. So funds roughly about 60%, I would say. Hopefully this pie chart hasn't been modified. 20% to stocks, 10% to bonds, and I can't remember, just a very minimal amount to cash, but I don't think I'm going to put this into the pie chart. And when it comes to diversifying your risk, when it comes to diversifying your risk, I'm going to be discussing in a minute the different types of markets you should be attacking. So do not just put it into big companies, put it into different kind of niches, different kind of like say technology, property, commodities. So by commodities, gold, silver, split your risk over different things, split it over different countries. So you're going to be seeing it shortly. I'll explain it. Okay, so let me just discuss in terms of my investment portfolio currently, and I'm going to be expanding on it, and I'll outline that as well. So, okay, the funds in terms of what I have currently is S&P 500. So this is going to be the American market, the 500 companies, 500 biggest companies there. You have the FTSE 250, which is the 250 mid-sized companies in the UK. I didn't go for FTSE 100, and the reason behind that is essentially the overall, in terms of reviewing the overall margins in terms of how much they have made over the last, say, 5-10 years, the FTSE 250 have seemingly done better. So that's why I've gone for the FTSE 250. So like I said, it's the mid-sized companies in the UK, so 250 of those. Then I've gone for the Legal in General Accumulation Fund, which essentially that's more diversified over the world. So there's quite a lot going on there. So it's a bit more smaller percentage of the American market again. So there's a little bit of a duplication there, but it's more smaller. And then it covers the rest of the world. I think the highest chunk is Japan on there, and the rest it's all over the world. That's fantastic. So you can see the level of countries there is quite a lot. On top of that, I was reviewing some information of how China has done crazy well. In fact, the economy is moving at a rapid pace in terms of how it's been doing. So I put some money into the MSCI China ETF fund. Again, I can't remember the level of companies that it's in, but again, it's more diversified over different companies in China. Then I've taken out a fund in terms of the property market now. I think it's very important, like I said, to diversify over different things. So not only these big companies, like that different kind of areas. So property as well. Property, you can see, is rapidly growing. It's getting more and more expensive for people to buy a property. So if you can't get a property and, actually make profit from there directly, put it into the specific iShares developed market property. So there's lots actually out there that you can consider. This is the one I've done. So guys, just looking at the funds, you can see that it's there's so much choice there. There's the S&P 500, the American one. There's a UK one. There's a whole world diversification there. And then also you have a different kind of area, the property side of things as well. Then I also have a ETC. It's an exchange traded commodity. And I don't actually know too much about this. All I know is that I wanted to put my money also into the gold side of things. This specific investment hasn't been doing too well. It's not a fund, just to let you know. Like I said, it's a ETC, and I would highly advise to put your money into gold or silver or something. And the reason is that I've noticed the value of gold has gone shockingly, it has increased, not like a huge amount, but over the last 10 years, it has been doing well. But this specific investment, I have been keeping an eye on it. It has been growing slightly. Not as much as I expected, but, it's a recommendation. It's a good idea to put into commodities as well. Bonds, I don't have any bonds at the moment. I am looking into that, like I suggested at the forefront. Stocks. So stocks, I do have a few. I have MX, which was doing really well, and to put my money into it. So I don't know if I've basically jinxed things for myself, but it has dropped a bit. But MX overall in the last, I think, 5 years has done fantastically well. So yeah, I'm going to keep my money into there. I've got Marks and Spencer's, a UK, it's not a department store. They do food and clothing and things like that. And it's been doing actually really well. Tesco, again, a UK supermarket, doing very well again. And Aviva, which is like a assurance products company, which is doing okay. It's not too bad. But I just expected a little bit more from it. It's not doing too great. But yeah, you can see there's a few options there. And the stocks I do want to get pretty soon is Shell, which is a fuel company that, provides, where I go to the petrol station to get fuel for the car. Taylor Wimpey, I think that's how I pronounce it. I can't pronounce the last name, Taylor Wimpey. Essentially, it's a property development company. And I think that was a good idea to it's a good idea to put money into there pretty soon, because market prices are rocketing for properties. So yeah, I can't actually directly buy investment property, so I'm going to put it into there. Greggs is a food, takeaway food company where you can just grab food on the go. They are also doing very well. I can see future plans for them in terms of expanding. They expanded a fair bit in my local area, so I can see they're doing really, really well. And during COVID, I saw that they were doing impressively well as well. So yeah, that's another one I'm going to be putting it into. Apple, because I'm a major fan of Apple products, and if it's something that you support or that you already use the product, I would highly suggest you invest in it, because if you support that product, if you already use it, it's good, then why not put money into it? And I have been reading forecasts that it's likely to do really well in the upcoming future. But guys, these predictions that these analysts do make is like indicative in terms of it's not like a solid. Everything can change. So something like, say, a stock or a fund that may not be doing well now, it could be doing 10 times better in the future. You just don't know how things are going to go. The last one is Microsoft, because again, I'm a fan of Microsoft products, but yeah, the share price for this is quite expensive. But yeah, I'm going to be looking to get that. So guys, yeah, you can see that's kind of the attack or approach I'm going to use when it comes to creating my balanced portfolio. You can see that diversity is key, not only in terms of the markets, the type of investment you choose, or the specific investment. I would say just think about it very carefully, do some research. That's very important when it comes to creating your own portfolio. Assess your risk level, assess what you want in the next 10 years, what you want to save for, and these kind of things. So guys, I hope this discussion in terms of my portfolio has been very useful. If you do have any questions, do note them below in the comments. Any suggestions, any recommendations, I am highly open to listening to those, because all of these are going to be very useful when looking at my portfolio. Yeah, guys, I hope you start a new year in a fantastic way. Focus on your money, guys. Make sure your debts are clear. Do not have any debts overhanging. I'm going to be discussing all of that on my channel anyways. So guys, thank you for checking out my video. Please do subscribe. If you did find this information useful, hit the like button. That will greatly help me out. I'll see you soon in the next upcoming video, guys. Take care from my end and see ya.